Welcome to the All Financial Hour podcast with Steve All.
Steve, as always, welcome. What's up? What's new?
Volatility.
That's very true. Yes.
It's what comes up must come down. They do say
yeah.
the markets are only guaranteed to do three things. One, go up, go down, or stay the same. That's about all we can do. And it's just been one of those weeks of, oh, my Lord, I'm glad that I'm looking at a long term. Because I think when people get caught in this, the biggest thing that it pulls into it's emotions. And when those emotions start to come in there, people make emotional decisions. And when they make emotional decisions, they're usually done at the wrong time. It's about the simplest way. We can look back at our lives, and a lot of those mistakes that we wish we wouldn't have made, we did them during emotional times, especially when it comes to investing and planning for our future. So the idea around it is to keep that focus in the long haul. Because I can promise you, probably 10 to 15 years from now, we're not going to remember what happened the first and second week of March of 2025. But right now, we're right in the middle of it, so we can feel it. And that's what I think the most advantage of having somebody that's a financial planner is to help focus on those things. Yes, I've had a few of those phone calls of everything's going, where am I at, what should I do? Let's come in, let's sit down and talk about it. Some of them, we just do it right on the phone. Mm-hmm. But it's very few because the people have been with me long enough that they know that we're playing the long game. I don't invest for quick gains. Give me the best return that I can get with the least amount of risk possible. That's the goals that I look with people. And if that's where you're looking for, please give us a call. Let's sit down and talk because I think that is what retirement is all about. Retirement is a journey, not a destination, so that you can enjoy your retirement. That's the goal for me and for our clients.
Continuing this conversation here with the most recent administration under President Trump here, they continue to use the threat of tariffs on certain goods coming into the U.S. We're hearing more and more how that's going to impact us as consumers here as well. So what could we expect if and when the dust settles? Well, here's NBC News business reporter Christine Romans.
You'll feel it in a new car, anywhere from $3,000 to up to $12,000 extra for the price of a new car. But maybe first you're going to feel it in the grocery store. Think of all of those things that are imported from Mexico and China. Mexico in particular, all of that fresh produce, all these perishable items. From Canada, we get gasoline. From China, we get electronics and toys. Mark Zandi over at Moody's Analytics says you should expect another $1,200 to $1,300 a year for the typical household just for the higher prices for all of these things.
So I know a lot of folks hear that and they're going, oh my gosh, if it's not inflation now, it's tariffs. Like I'm barely treading water trying to get by. Now I have another problem here. Steve, you got to help us out. How do we kind of battle against this?
Again, I think it's keeping the focus. We've always had it. I get the inflation, it's never going to go down. And I said, do you remember back in the 80s? I remember borrowing money as a business owner at 18 to 20%. That was the going rate. I'm glad that inflation doesn't stay because if it did, it would still be here. So it goes down. And then we reflect back about 5 years ago when we had almost no inflation. Social Security checks never got raised for a couple years. So inflation is going to go up and down. Yes. Does it hurt people? Yes. Does it hurt people on fixed income? Yes. Is it good? No. I will go with all of those. But what the, quote, back and forth with all of the tariffs and it's creating right now is uncertainty. And uncertainty drives the markets in the big swings of ups and downs. One day tariffs are on, one day tariffs are off. So the market goes up, the market comes back down. So that's where we start to look at it and say, how do we focus on something that is further out in front of you? And then I like it with the market guard. A well-balanced, diversified portfolio. So I don't have all of my eggs in one basket. And as it puts, when you take it, he said, investing's kind of like making chocolate chip cookies. You got to have the right ingredients. Vanilla and vinegar both start with V, but I wouldn't put vinegar in my cookies. I would put vanilla. And you got to have the right amount. Would I make cookies with 6 pounds of sugar, 5 eggs, and a little bit of vanilla? No, it would come out like soup. So I need the right allocation. Too much of any one thing can spoil a cookie. And then the big thing is, how long do you keep it in the oven? Do you like your cookies more well done? some, like me, I just as soon be dough.
Right.
Some like it soft and chewy. And I believe that's the same with the portfolio. You got to have a good diversified portfolio. You got to have the right amounts in each one. And how long do I keep it in the ovens? Where's my risk tolerance is at? Am I more aggressive or am I conservative? And what clients like the most about the market guard portfolios is the idea that when are they going to take the cookies out of the oven? Proprietary investment methodology. Non-emotional, methodical, mathematical, changes the tactical models every month or when necessary. So there were some changes at the beginning of March. Some of our more conservative portfolios are still up this year, whereas the S&P 500 is down. So those are the things that you can look for.
There's a recent study by Schwab, and they have a list of where most retirees are getting their income. Here's what they have: 40% 401k, 20% Social Security, 15% savings and investments, 11% pensions, 4% part-time work, 3% annuities and insurance, and then another 3% real estate. So that's 7 different places where folks are getting their income there. Steve, would you add or take anything away?
I think that makes it up, but it's been a big shift. Many years ago, the pensions were a lot higher. Now it's 401ks and savings. In my opinion, those are the exact same thing because I saved all my life. So the idea around it of it is I like to look at it with my clients and sit here and say, how do we answer the question, how am I going to replace my paycheck when I quit working? And I think that's what we have to look at. How much income do you have in guaranteed, Social Security and pensions? And what's your lifestyle expense? And can I set aside enough of my money to create an income stream that I cannot outlive? Would that make sense to cover my lifestyle? I believe it is. I think annuities have gotten a bad rap because years ago, if you prematurely passed, Uncle Joe died and they kept all his money. They've corrected a lot of those things. But I like that personally funded pension where you put some of your money in to guarantee the lifestyle of you and your spouse, if that's what you choose. And if you prematurely pass, it goes on to your family.
Even with volatility in the stock market right now, there are those who remain bullish. One is market strategist Ken Paul-Carey, and he cautioned Fox Business that there may be one thing that could throw a wrench in this entire picture.
I think the problem this year is going to be inflation. I think the Fed was too aggressive last year when they cut rates. I think they reignited kind of the inflation monster, and so I think the Fed's going to have to stand pat. Now, to that point, it doesn't mean that the market can function. We can have 4.5% or even 5% 10-year if the economy remains strong and vibrant and robust. The problem's going to be is if we start to see the labor market weaken or the economy weaken and then we see inflation move higher, that would then be the issue.
All right, so we talked about if the economy remains strong. At the bottom line, guys, there's a lot of ifs floating around here for investors, especially nearing retirement, and they are looking to protect their income, their money. Steve, what are your thoughts?
I think if you line enough, as they call it, investment market strategists or economists, you get enough of them and you're going to hear whatever story that you want. If you think it's going to be doom and gloom in the future, you're going to find the people that give you the doom and gloom reports. If you think it's going to be great in the future, you're going to find the people that are going to tell you that. It's our personal biases that get into it. My statement behind it is your plan built for whatever happens. What happens if the market goes up? Because it will. What happens if the market goes down? Because it will. And I think that that's where we have to start looking at a financial plan that can survive any of those. In my time in the practice, I've kind of gathered some things that most people are interested in. And I like to call them the 3 Ps. Basically, almost everybody out there wants to participate in the market when it does go up. Steve, if you can get me a predictable income to replace my paycheck, that's the second one. And the last one is, what can you protect me from large market declines? And I think those are the 3 things that almost everybody's looking for. So that's when we start to look at it, and I start to look, is how do we build this into a portfolio? I think having a big basket of possibilities in your portfolio basket is very big. Having those individual stock portfolios for those people that they want to go for it with a little bit of their money. That's the money that maybe they're leaving for their kids and their Roth accounts. Let it grow tax-free. And then we got that money that, hey, I might need to spend in the next 1, 2, or 3 years if I'm pulling money out of my portfolio to make things work. I want those a little bit more conservative, and then when we start to look at income streams, how am I going to replace my paycheck in retirement? Do I want it guaranteed or just want to pull money out of my portfolio? Because that's what people are looking for. And then protection. The worst thing that can happen is big negative markets right when you decide to make the decision to retire. The problem is nobody out there has the crystal ball that says what's going to happen in the next 6, 8, 10 months. Are you prepared for whatever happens if you're close to retirement, as you put it? And I think everybody's plan should include the following things. Do you have a tax strategy? Yeah, we're talking that the taxes might get lowered this year. I don't think it's going to be a realistic, but I do believe that they're going to be higher in the future. How are you going to replace that paycheck? Have you looked at Social Security and optimizing Social Security? I think that's one of the biggest things that we have. And then we get into legacy planning. What are we going to leave as a legacy? I like to say memories can be sometimes more important than dollars. Mm-hmm. What if we can leave both? What if we can leave both? And having the availability of a protected portfolio, limit those declines. Those are the things that I think most people that I've talked to over the years are looking for. So if your 3 Ps would fit into your retirement strategy, participate when the markets go up. A predictable income, protection against large losses.
Steve, I recently read online about a 73-year-old widow who has been waging a 13-year war with her late husband's longtime employer. At issue is his $53,000 pension, which the company apparently refuses to give her. Why? Well, apparently he failed to fill out a form that made her the beneficiary upon his death. Huge mistake here in the world of estate planning and, income planning in general here. So can you tell us about others and, of course, how we can avoid these mistakes?
Well, I think the big thing that we can talk about here, one, I'm not a lawyer. I don't draw up legal documents. I just got some experience in the field, and I have seen some horror stories. It's about the easiest way to put it. Mike and Jerry came in for planning, had a very nice estate. I kept telling them, you guys need wills, trust. Wills probably wouldn't be deal, and you need powers of attorney. I don't do it, but I need you guys to go talk to somebody about it. They wouldn't do it. It was one of those ones, and I've probably told the story before. He looked at me and he said, Steve, my kids have fought with me my entire life. Let them fight when I'm dead.
Oh, my God. Come on,
so I made him sign a document so that when the kids came in after he passed away, here's the document that I ask about this. Not updating your forms. That's probably another one. We had a person that passed away. Diane passed away second. Their trust had 2 successor trustees that had passed away. She had to track down their death certificates before she could become the successor trustee. She was third on the list. So updating your documents is very, very important. And probably one of the worst ones was powers of attorney. The state's got a will for you if you don't draw up a will. It's not the way you want your assets divided, but it will happen. But the powers of attorney are probably the most important one. And we had asked the client, do you have powers of attorney? They said yes. And shortly after the gentleman retired, Jim had to go into a facility and he couldn't make a financial decision on his own.
Oh, no.
And his money, most of it was in IRA accounts. Mm-hmm. That's individual retirement accounts. Without a power of attorney, we can't take his wife's request to take money out of the account. The power of attorney that they had was for real estate deals. It wasn't for a general or, a power of attorney that would work for all financials. The kids were fighting over who should get it. Ended up having to go to guardianship. And it was about a 3-year battle for somebody to figure out who was going to help take care of their father's estate. So those are the things that I believe that legacy planning can keep you from having to do. And like I said, we don't draw up legal documents. We are not lawyers. If you Want to get a comprehensive retirement plan? We can look and see where you're at, and we can also make a referral to the attorney that would fit for what you currently have as a need at this time.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.